All right, so today we're going to be talking about Bitcoin and the idea of non-sovereign money. So basically money that is not controlled by a centralized entity or the state traditionally. So centralized money is issued by the Federal Reserve here in the US. And what used to happen in the past was that the dollar was pegged to gold. So each dollar note was a representation of gold that used to be in a bank. And what happened was that got separated to where fiat currency was no longer attached to gold. And so now we have a currency regime where you can print any amount of money, which I'll talk upon later. So fiat money, or the dollar, or whatever other currency, the euro, is centralized versus non-sovereign money, which operates outside of these centralized institutions. And in the case of Bitcoin, it is global. And Bitcoin was the first type of these currencies that was actually accepted by the globe and has been in circulation since. And so the main problem that Bitcoin is solving is this problem of debt that is being experienced across all different countries around the world. The US, Japan, China, and Europe are all under regimes where any type of issue they run into in the government, they will just print massive amounts of money. The reason why they can do this is because their currency is not tied to anything that is fixed. They can simply print more money. One of the issues that Bitcoin solves is the issue of scarcity. With only 21 million coins, you solve this issue because you can never have more of them in circulation. There is a fixed amount. So it becomes more valuable if the denominated currency is the US, it gets printed more, your Bitcoin will gain more value. And also there is no single country that can control your currency. So say if you want to get your money out of China and your bank is doesn't want to let you transfer your money to the US, you don't run into these issues if you have your money in a system that is not centralized. So now moving on to the cycles that this asset experiences. And one of the most clear one is the halving cycle, where the operation you do to mine a new Bitcoin, the reward that you get gets reduced. And so these lines happen every 4 years, and it's a moment where Bitcoin goes through the halving. So essentially, the miners are mining these Bitcoins, and when they do, every 4 years that gets reduced in half. So it becomes more and more hard to mine these Bitcoin, and so the price generally goes up. The other thing to consider with Bitcoin is the hash rate and the security of the system. This is a chart of the hash rate from its beginning to 2026, and as we can see, it only goes up. The reason for this that the hash rate goes up is because hash rate is a measure of how difficult it is to mine each Bitcoin. And so this chart itself is a representation that every single time throughout time it has been harder and harder to mine this Bitcoin. Hash rate is a representation also of energy. So for you to produce a hash, you need to input energy. What does this mean? Every time you want to become a provider of a Bitcoin service, you have to input more energy because you need to produce more hashes. Is this correlation clear, or is it still a little confusing? The more hash rate that the network requires to operate, the more difficult it is to do an attack. I don't know if you guys have heard of a 51% attack. This is where some entity theoretically can control 51% of the compute of the entire system, and they will use that compute to create a separate line in the blockchain and thus create a illicit transaction or double spend. And what this is showing us is that each time you require more compute and more energy, making it more difficult for people to hack the network. And this is another interesting chart that this produces. This is the chart of the cost of the miners. So in this Bitcoin ecosystem, You have the Bitcoin itself, which is the black line with the price, and then you have the miners, which are the ones that provide the service of having Bitcoin online. And you can think of it as what does it cost to a miner of gold to go and mine the gold? Each time it becomes more difficult, you have to go deeper in the ground to mine the gold. Each time the price to mine the Bitcoin goes up. And this gives an interesting relationship, because if the price of Bitcoin were ever to fall under the price that it costs these miners to mine the coin, you see the miners go underwater. And what they usually do is that they would defend the network by hoarding the coins. They don't sell the coins that they mine, and that reduces the supply in the market and makes the price go up. Now I want to compare Bitcoin with gold. So gold has been here for thousands of years at this point, but they essentially do the same thing. They're supposed to be scarce and durable digital assets. The reason why some people believe that Bitcoin is superior to gold is because of the transactability. For example, if I wanted to send someone in the European Union right now a certain amount of money in gold, I could not physically do it, even if I so wanted to. I can't take my bars of gold through the airport and take them over to the European Union. It's illegal. I can't carry metals like that. You could argue that you could send in some other form, but with Bitcoin you can simply, or any cryptocurrency, you can simply transact them on the phone. And it's extremely quicker. It also trades 24/7, and it has global liquidity. Also, for example, a bar of gold, if you want to make smaller transactions, you can't carry your bar of gold and then cut it up to make a transaction for, say, your pizza. You can't do that. For Bitcoin, you can divide it up and you can make smaller payments. The other thing that we're seeing in the Bitcoin space right now is that we're seeing massive institutional adoption. I was seeing a Twitter post today that was saying that institutional adoption is breaking the core value proposition of Bitcoin, but it's not. It's like saying, because it doesn't change the intrinsic value of the asset. It's still a store of wealth that is globally distributed, and it doesn't change anything. So what we're seeing right now is we're seeing ETF issuers come online and push wrap this product and push it to traditional asset managers. And we're also seeing large corporations put it on their balance sheet. And I have a video here that shows you how it changes throughout time. So at the start, you don't have a lot of mine and it's mostly individuals. You'll see how it changes. You can also see that the supply gets slower and slower. It stands slower. So around this time, we're going to start seeing the ETFs and the corporations. There's MicroStrategy, the first one, Tesla. There's the ETF and the funds. Companies, governments. So we're seeing this big shift going on where this Bitcoin is being transferred from individuals' hands over to institutions. And this is great for anyone that wants to hold Bitcoin because it means that it's no longer illegal and that now we have access to the true capital, which is in hedge funds, it's in asset managers, it's in pension funds. So this puts a lot of upward pressure because there's so much more money trying to chase a specific asset. The other thing to look at is the correlation between Bitcoin and global liquidity. So global liquidity is the action of all central banks across the world. So the European Central Bank, the US Central Bank, it's everything that they do with currency, is how much money they're putting into the system through balance sheet movement or quantitative easing, or if they're printing more money. And what this chart up here shows you is that there is an 89% correlation between what the global liquidity index does and the price of Bitcoin does. So what happens there, what that's telling you is essentially Bitcoin is extremely sensitive to global liquidity and is the actual mover of this asset. So if you want to track something to see if the price is going to go up or down, track global liquidity. And this is another representation here of the same correlation. You can see that when generally speaking, because it's not perfect, when you see rises in global liquidity, you'll see usually the price of Bitcoin appreciate. And the interesting thing is that right now we're seeing a big drop in Bitcoin while global liquidity is still expanding. We also see from the Fed right now that we're going to have a new Fed chair. We already have an expectation of 3 rate cuts. This is more liquidity into the market. We also saw that they stopped tightening the Fed balance sheet, which precedes an expansion in the balance sheet, which means even more liquidity. We see, again, from the charts before, the Chinese expanding their expanding liquidity, the Europeans doing the same, the Japanese doing the same, everyone's doing the same. And so this asset monetizes all of that. But the other promise that we were given with Bitcoin is that it's going to be a store of wealth asset. And we have not seen this at all. We have seen it react is to risk, which eventually we hope that changes. But for now, that's the regime we're under. I also made these 2 pie charts. This was 2024 comparing the market cap of gold against the market cap of Bitcoin in the store of wealth market. So Bitcoin used to have a 8.5% ownership of this market against 91% of gold. And what we see right now is that gold went on a huge bull run. Now it expanded from 15 trillion to 34 trillion, while Bitcoin has roughly stayed the same. And depending on how you see this, personally I see this as a very bullish thing. Because if you consider that the movement was purely in gold and you make an assumption that Bitcoin will hold the same 8.5% or the same 10% that it used to, what happened was that the underlying market expanded while Bitcoin remained the same. So Bitcoin should appreciate with this expansion of the total market. Assuming Bitcoin recaptures at 10%, that would give us a price of $200K per Bitcoin. And if you make further assumptions like this is a better technology, you see it capturing a 15%, you see it start eating market share of gold, you can start seeing easily numbers like 300, 400K. And if you put it to the balance sheet of companies, if hedge funds take it on, if pension funds take it on, $1 million Bitcoin doesn't seem too out of the picture. And the other thing is that Bitcoin isn't used, for example, like Solana or Ethereum to make quick transactions. The behavior of people that own Bitcoin is store of wealth. So they'll put their money in and they'll keep it there. And speed of transaction isn't really an issue. People are just transacting large amounts of money between each other. So it's not like a quick type of asset. It's to store your wealth and leave it there. Okay. And I just wanted to do a little exercise, but we can just do it by raise of hands again. Who still prefers gold over Bitcoin? Can you raise your hand? That's fair. So that's about half. Who prefers Bitcoin?
Well, like in terms of investing or in terms of like keeping your money safe?
Keeping your money safe. Gold? Okay. For example, where would you keep your gold if you had it?
I would just buy it from like a bank or something.
Okay, hold it cash?
Something like
Like hold it in a broker?
Yeah.
Yeah? Okay. Cool. And that's it, guys. Thank you very much. Pizza, pizza, pizza. Huh?